You think the S&P 500 is the safest place for your retirement money, but one small choice can quietly cost you thousands. Most people assume SPY, VOO, and IVV are basically the same. They all track the S&P 500. They all look safe. They all seem cheap, but they are not built the same. In 2025, the S&P 500 gained 26%. SPY slightly lagged behind because of its older structure. That gap looks tiny on paper, but over time it adds up. The problem starts with SPY's design. It was built in 1993 as a unit investment trust. That older structure creates two major issues. First, SPY can hold dividend cash for a period of time instead of putting it back into T. He market immediately. That creates cash drag. Your money sits still when it should be compounding. Second, SPY charges a 0.09% expense ratio. That may sound cheap, but today it is actually expensive for a plain S&P 500 fund. VOO and IVV solve both problems. They use a more modern, open-end fund structure. They can reinvest dividends faster. They also charge only 0.03%. So if you are a long-term investor, SPY is usually the weaker choice. It still works well for day traders because it has massive trading volume and tight spreads. But for someone building wealth over years, lower cost matters more. That is why most long-term investors now choose VOO or IVV. VOO and IVV are nearly identical. Both track the S&P 500 closely. Both are low cost. Both are highly liquid. For most people, picking between them comes down to preference. If you like Vanguard, pick VOO. If you prefer BlackRock and eShares, pick IVV. Either way, you are getting a modern, efficient S&P 500 fund. Then came a new fee war. State Street, the company behind SPY. New investors were leaving for cheaper funds, but they could not easily slash SPY's fee without giving up huge revenue. So they pushed another product instead. They turned a smaller fund into a lower-cost S&P 500 option. That fund became SPIM. SPIM charges just 0.02%. That makes it one of the cheapest S&P 500 ETFs on the market. Now, let's be real. The difference between 0.02% and 0.03% is tiny. It will not change your life overnight. But SPY does have one practical advantage. Its share price is much lower. A single share of VOO can cost hundreds of dollars. SPY is much cheaper per share. For smaller investors, that feels easier to buy. Yes, many brokers now offer fractional shares. So mathematically, share price should not matter much. But psychologically, people often prefer owning whole shares instead of fractions. So, the lineup is simple. If you are an active trader who needs maximum liquidity, SPY still has a place. If you are a long-term U.S. investor, VOO and IVV are usually the best standard choices. If you want the absolute lowest fee and a lower share price, SPY becomes very attractive. Now, let's talk about Schwab, because many people get confused here. A lot of investors open a Schwab account and assume Schwab must have its own S&P 500 ETF. It does not. Instead, Schwab offers alternatives like SHAYHX and SUPPX. SHX is not exactly the S&P 500. It holds about 750 large U.S. companies, not just 500. That means it includes extra companies outside the official index. Sometimes that helps. Sometimes it adds more downside risk. SUPPX is closer to the S&P 500, but it is a mutual fund, not an ETF. That means it works a little differently, especially in taxable accounts. So, if you use Schwab, do not assume you must buy a Schwab branded product. You can still buy VOO IVV or SPY through Schwab with no commission. Your broker does not have to match your fund. Now, here is where things change for international investors. If you live outside the United States, buying a U.S. domiciled ETF like VU can create tax problems. The biggest issue is dividend withholding tax. In some countries, the U.S. can take a large portion of your dividends before you ever see them. There is also estate tax risk. If your U.S. holdings become large enough, that can create another serious problem for your family later. That is why many non-U.S. investors use Ireland domiciled ETFs instead. One popular choice is VUA. VUA tracks the same S&P 500 index, but it uses a structure that is often more efficient for international investors. Because it is based in Ireland, the tax treatment can be much better. It can reduce dividend tax drag and help avoid U.S. estate tax exposure. That is a huge deal over the long run. VUA is also an accumulating fund. Instead of paying dividends out to you, it reinvests them back into the fund. That helps compounding and can make tax reporting easier in some countries. Yes, VUA charges more than VU. Its fee is higher, but for many overseas investors, the tax savings are far bigger than the extra fee. So, the best fund depends on where you live. If you are in the U.S. and investing for the long term, VU or IVV are hard to beat. If you want the cheapest fee and lower share price, SPIM is worth a look. If you are outside the U.S., VUA may be the smarter option because taxes matter more than the headline fee. That is the real lesson. The S&P 500 itself is not the problem. The ticker you choose is the problem. People spend years obsessing over stock picking, market timing, and predictions. Then, they ignore the simple structural details that quietly eat into returns. This is not about finding a magic investment. It is about stopping unnecessary leakage. If you own SPY as a long-term holding, ask yourself why. If you are in the U.S., compare it with VU, IV, or SPIM. If you live overseas, check whether a fund like VUA fits your tax situation better. One small change will not make you rich overnight, but over decades, small costs become big money. That is how compounding works. And that is why picking the right S&P 500 fund matters.